Blackstone just capped withdrawals of its biggest private credit fund. Its investors cumulatively asked for 10% of the fund to be withdrawn, and Blackstone gave them half. Now, I'm sure you've seen the news headlines right now that private credit is the next blow up, and I get why you'd feel this way. It almost sounds a lot like 2008. But in 2008, we said that housing was over. We said the American housing and the financial system would never recover. Well, it didn't. A thin slice of bad mortgages were the bad apples in that bunch, and it took the whole world down with it and made a whole narrative about that. Well, private credit is having its moment like that right now. But I want to get into what's actually real about what to be worried about and what's being sensationalized and overblown. So let's get into it. A few months back, I walked through the private credit funds that were actually having issues. I was reading the different prospectuses and trying to understand where it is that they could have gone wrong. And what I saw was kind of what you'd expect. Bad or sort of rushed underwriting, loans going sideways, companies that probably wouldn't be so fundable in today's economy. That stuff truly earned the right to worry. But I want to show the other half of the story, because here's where most investors are right now. They have cash on the sidelines, and private credit looks like steady income without the stock market swings, but then the headlines hit, right? Funds that are freezing the ability to withdraw when people were told they could pull their money out at a moment's notice. And Jamie Dimon of JP Morgan Chase has even warned about, the cockroaches in the system. When you see one cockroach, there are probably more. That's his quote here. And I'm sure you're wondering right now, is this a trap? Am I going to catch a falling knife if I do anything in the space going forward? Well, some of that fear is definitely merited. There's real stress in one corner of private credit. But most of what's been getting called a crisis is not one. And let me show you why. So private credit is basically just lending outside the banks. It's a whole chapter of money going somewhere for a fixed yield or sometimes a floating rate yield. And a lot of the sort of the conventional banks don't necessarily play in these categories either because there's higher risk or they're harder to underwrite or they're maybe just smaller or misunderstood. But that's what private credit is. And it's not one thing, by the way. It's 100 different things that are all wearing the same hat. So the headlines that we're seeing are kind of about one of those hats. It's big pools, big funds that have money from lots of retail investors that lend out to large companies. And the problem is the wrapper that they put around them. These people told investors that they could pull their money out every single quarter. And yet the loans that they have, that they've originated to these companies, take years to pay back. So when everyone heads for the exit at once, the fund can't sell fast enough. And that slows the line down. That's the gating that we're hearing about, where investors are being restricted. What do you think that does, though? That creates a panic effect, and then more people want to pull their money out. But these loans are fixed and they take years to pay back. And so you have this sort of virtuous cycle that creates panic in the market. Now, is that panic merited? Again, some of these funds, they are going to see markdowns, but a large percentage are actually perfectly healthy with well underwritten standards and, bankable loans with good interest rates that the banks just never took on. And this is what the headlines are skipping, because across the whole market, most of the loans are performing. Now, real losses last year ran under 1%. So think about it. Only a handful of badly run funds with genuinely bad loans, basically the ones I just covered, or the ones that, have these issues that are having defaults. And that wave of funds capping withdrawals right now, it's a whole different problem. It's not actually linked per se to the loans themselves. JP Morgan looked at it and said the rush to the exit, it was driven by fear, right? Not just the loans going bad or anything like that. So it's not houses getting foreclosed. It's a traffic jam at the exit door, if that makes any sense. So now the part that doesn't actually help me sell anything, because I'm a big private credit proponent and we're launching a fund in the space later this year. So I've been spending a lot of time here, but good private credit is inherently illiquid. Your money is locked up, and that's not a flaw. I don't see it as a bad thing. It is the deal. It is the reason we get these good returns in private credit. Blackstone's own president has called this a feature and not a bug. It's actually a benefit, and he's right. The mistake that those funds made was promising easy access to something you could not access easily. And so anyone selling you high yield and your money out at any time is selling you the exact mismatch that's creating the headlines in the panic wall and all that stuff. The honest version sounds worse than that, and it's actually safer. Your cash comes back on the loan schedule, or maybe even a little bit after, but it gets paid late fees with interest and gives you a better return. You're locked up until that point. And frankly, if you can't handle your cash being locked up for the life of your loans, then you probably should not be in the category, plain and simple. Now, I believe in full transparency. And I really think that the private credit crisis is as much a transparency problem of what was in the fine print as it is with the actual loans behind the book. Now, I invest my own money in private credit too. And I'm talking everything from real estate as a lender, as a passive investor in debt funds. I've been doing a lot of film bridge notes lately. I mean, I have a pretty diversified credit portfolio and we're evaluating, several different things. So just that to say, I have ponies in this race. But the lens that I apply in action is while we look at this corner of lending, and we've seen some places that pay 20, 30, even 40%, I mean, absolutely stunning yields, we've passed on those opportunities. And the reason is because there was no real collateral behind them. As much as I was told that everything's backed by whatever, at the end of the day, when things break and you need to get your money back as a lender, whatever you have to go and get it back from better be worth more than what you paid for the loan, right? It's just a critical, basic part of this. And if the borrower stops paying and there's nothing solid to grab, that high yield threshold is never a free lunch, right? It's risk that oftentimes you can't see dressed up as a reward. So a lot of times when I see these headline high yields, I actually get more nervous and I start to really double click on the downside scenarios and the back testing and what happens in recessions to those asset classes, all that kind of thing. That's the game. That's the rule if you want to survive in private credit and you want to make money in it. It's not chasing the biggest number, but it's asking what's behind it. It's asking what happens when things break. And what surprised me about looking at this category and getting serious about it is how often the safe looking deals had the thinnest collateral. It's not always just the really high yield stuff. Sometimes it's a 10 or 11% yielder and something that really just isn't actually protected, and it's deep in the fine print when you realize that. Two more things that we hold firm on when we're looking at private credit opportunities. We always want hard collateral, especially real estate if possible. So if a loan goes bad, there's something real, not just a logo or a used pizza oven or something like that. And we only back lenders who keep their own loans on the books. And I think this is a critical part because a big part of private credit is reliant on reselling loans, but that requires another market participant to buy them. And what happens if things change or shift in the market and those buyers evaporate? Well, you have a lender that originated loans that never meant to hold them, that's then stuck, and that can lead to some serious outcomes on capital impairment. So if their money stays in the deal from the get-go, your interests are often more lined up as an investor. So before a dollar goes into anything called private credit, I want you to run 4 questions of whatever you are looking at. One is, what is the collateral and what is it worth against the loan? This is by far, I think, the most important question of all. But I really want you to have a sense of what is that thing worth at the end of the day? Because if it's, a 1-to-1, you're likely not going to get your money back if something hits the fan and the loan goes into default. Number 2, how long is your money locked? And does that structure honestly match up with the loans that are being originated? See, it's 2 different parts. One is the investment that you're making into the private credit fund or situation. The other is what they're doing. And you want to see those things match up if possible. 3 is how long has this group done this exact lending? And did they do it through a downturn? Back test it. I want to see the books. I want to see the loan tape. How did it perform? That is an absolute critical step when you're evaluating, because a lot of these things look great when the market's booming and can see enormous write-downs when things turn, and we never know when that's going to be. And 4th, how is the fund actually getting that yield? If the answer is taking piles of borrowed money and putting it out there on the street, well, that leverage can cut both ways, because in good years, again, it can really amplify returns, but it wrecks the bad ones, right? And it can be really dangerous when there's excessive leverage in some of these funds. So those 4 would have kept people out of almost every blow up you have read about on the headlines. The same questions that we ask before we ever bring a deal to investor are the ones that I want you looking at whenever you're evaluating private credit. So private credit is not a bubble. It is one slice that is not keeping a promise that it made, and the headlines are painting everything with that same brush. I don't want you to fall for it. There's lots of alpha in private credit. There's protection in private credit, but you need to know where to look and you need to know how to evaluate. So if you are weighing out private credit for your portfolio, I built a 2-minute assessment. You can find it at www.oceanridgecap.com/quiz. It'll help you to see where you're going and what kind of investor you are and how types of private credit and equity can help you reach your goals. Make sure to check it out. Link is in the bio, and we'll see you next time.